Hi, I'm Scott Deveau. I'm the deals reporter with Bloomberg. I specialize in shareholder activism. We have the privilege today to have Jonathan Pollock, co-CEO, co-chief investment officer for Elliott Investment Management, the $48 billion activist fund. I was about to say it's based in New York, but now during the pandemic, they moved their headquarters down to Florida. John, thanks for coming in today. It looks like you're in the office. Are you in the New York office, Florida office, or?
Yeah, Scott, thanks for having me. We're actually in the Greenwich office, is our new office in Greenwich. But as you know, we did move to West Palm, but we still have a substantial presence here in the Northeast.
You were part of the exodus from Wall Street to Florida over the pandemic. There were a lot of hedge funds that moved down there. What do you think that means to the culture of Wall Street going forward?
You know, I don't really know much about the culture of Wall Street. We're kind of, in it, but not of it. Look, I think that technology today allows us to be connected in ways that we haven't been in the past. I don't think it's really central to be located in a specific place. And so, yeah, I don't think that it has any big impact.
Okay, so the last 2 years have been obviously, unprecedented. I'm just curious, Elliott has a platform in private equity, activism, credit platform in distressed, a real estate portfolio. You're pretty well across the entire market, and I'm just curious, what kind of challenges and opportunities did the pandemic create for Elliott?
Well, you're right. We're not just an activist fund. We're a multi-strategy fund engaged in a variety of things. Look, we were busy during the pandemic lows, as everybody was. Probably didn't put enough money to work at the lows, but fortunately, we do have all these businesses, and it's a relative value game for us. So in the activist space, we're both long and short, and we're still, even at these levels, which are up dramatically from the pandemic lows, we're finding things to do. We've also been lucky to put money to work in the private equity space. And we're looking for companies that have sustainable cash flows that we can own with confidence through the cycle. So that's been an area of deployment that's been fairly satisfying for us. But also, we're in the direct real estate space, and we have been active throughout Europe mostly, but we've done some things in the States as well. So we've been pretty busy.
It seems like you've taken a lot of active positions in Europe this year. Are you seeing some kind of opportunity in the European market? And more generally, I mean, how does Elliott determine what companies it's going to target in an activist situation?
We screen companies globally, and each situation is unique. So we've never put money to work based on a specific geographic theme. It just happened that in Europe, a few situations did line up. But lining up for us means a whole variety of different elements need to come together, and they happen to with these companies in Europe, but we've been active, in the U.S. as well. So we've managed to do a lot of work. Each situation is unique. You have to go through and take your time and really pick your spots, and that's what we try to do. And we try to populate the portfolio kind of situation by situation, brick by brick, and that's how we build it.
I'm curious, it looks like inflation and interest rates are likely to continue to rise. What do you think that means to the broader markets and for Elliott's business in particular?
Well, I think we've all enjoyed the benefits of low rates for a long time, and ultra accommodative monetary policy globally. Anybody that's managed to put risk on the page in the last 13 years, but more specifically in the last 18 months, has been well rewarded. I'm not sure it's all genius. I think those tailwinds have made us all look good. But now I think the cycle is evolving. And so what does that mean? If you think about just taking a step back, I don't know if you've seen these numbers, household wealth has increased by about $5 trillion for the last 5 quarters, $5 trillion. So I think we're at all-time highs for household wealth to nominal GDP, which is like at 6.25 times. At the same time, we have household wealth at like almost a 50% allocation to equities. So you start to think about, is there real sensitivity to rates? Is that wealth imperiled? Bank of America recently did some work on the S&P and figuring out what the duration of the S&P was, and I think they came up with 35, 36 years, and composition makes a difference, a lot of high growth companies. But then Goldman did the same analysis for the Russell 1000 and came out with a 22 duration for equities. Well, if you start fooling around with the numbers, 100 basis point move for a 22 duration zero coupon is a big move. It's down 20%. And I'm not saying that the market's going to go down 20% tomorrow, but I am saying that there is sensitivity. Where that attachment point is, it's a whole nother question.
Do you have any sense of when that might occur, or why the market's not reacting at this point?
Okay. I think it's really, really difficult to know. Right now, it feels like we're in this Goldilocks moment with the Delta variant behind us, people coming back to value, rates rising. I mean, just in August, rates were, the 10 years at 110, we're up 40 basis points or so. And you haven't seen any real move in equity. So it's really hard to know when that comes. But right now, with earnings growing, I think, and again, with the recent past that it only has paid you to buy the dips, I think that mentality is kind of still in full swing. Hard to call it top.
Okay. So over the last few years, there's been an evolution in the credit market. You're a big player in the credit market, in particular in distressed. There's been a movement by big private equity players and non-bank lenders to move into the space, Blackstone, Apollo, even yourself, and displacing traditional lenders. What do you think that will mean as the credit cycle evolves?
Well, times used to be that in the cycle, there would be plenty of opportunities in the credit space. And I still think there will be opportunities. But I think, as you point out, the composition of the players have changed to the point where they're better placed to own credits, distressed credits, stress credits, through the entire cycle. So if there's a process, these players, the Blackstones, the Ares, the Apollos, they're better placed to hold on to it. So I don't know exactly what that means for the next cycle, but it could mean that opportunities are less plentiful. It's important for us to think about how to configure ourselves to play. And so, we're busy thinking about what that means to us, just to ensure that, we'll be there for those opportunities that do arise.
What does that mean? I mean, how do you position yourself for that kind of cycle if people are holding the paper longer?
Well, look, as we saw in energy, and I think as you've written about, there have been opportunities in the energy space for alternative players like ourselves, and I think that kind of space, whole energy space is in transition. There will be opportunities. It's important to have the depth of industry coverage, but it's important also to have some platform companies of your own to originate your own volumes, so you'll be able to put money to work throughout the cycle.
There's been an interesting situation developing out of China with the Evergrande situation, and it kind of highlights the risk of investing in China. Elliott's been hesitant, I think, to some extent to dabble in the Chinese market. Why is that? And I mean, is there any opportunity for you there?
Well, look, China's been a difficult market. For us, we're deeply involved in every position that we run. And, it's often the case that, we need to lean against the rule of law that's consistently applied. And I think in China, it's been one of those places that made that more difficult for us. So traditionally, we haven't been big players in China. I do think that there will be opportunities as this kind of policy generated slowdown occurs, but it's harder for us to think about big deployments in that geography.
So another area that you've been quite hesitant to get into is the cryptocurrency market. I think at one point, Paul Singer referred to it as the biggest scam in history. I was wondering if Elliott's views on the crypto market had changed much, or do you still believe that there should be some hesitancy in terms of investing in it?
Look, Scott, we're naturally skeptical about everything. You know, crypto is it's really, I think it's done a lot for the world. I think blockchain technology is going to be rolled out through a variety of industries, and it's a really, really important technology. You know, whether, you know, Bitcoin and Ethereum, you know, survive at the end of the day, I'm not sure. Look, we just saw China, ban the use of Bitcoin for transactions. And when you think about it, and the whole space kind of impinges on the domain that's traditionally been, you know, that of the sovereign. And so when I think about the potential risks, I think about, well, what happens at the introduction of an electronic dollar? What does that do to the value of crypto? And I'm not sure that it's a positive. I do think that it's likely at some stage we can see an electronic dollar that's controlled by the Fed. I think that has various elements that will appeal to the policymakers. Whether that can coexist with Bitcoin and Ethereum is I don't know, but I don't think it's necessarily a positive for the value of Bitcoin and Ethereum when it does happen. But when it happens and at what level Bitcoin and Ethereum will be at, it is hard to know.
Yeah, it seems that you know, if there was a federal alternative, it might lead to some kind of devaluing of the existing systems. Is that what you mean, or?
Yeah, look, I think the whole value of you know, Bitcoin, Ethereum would be challenged if that were to occur. I mean, it's hard for us to invest in something that could be, you know, effectively regulated out of existence with the stroke of a pen. Right.
So Elliott earlier this year raised two special purpose acquisition companies. Since then, the SPAC market has started to hit some hiccups, I guess would be the generous way of saying it. I know you can't speak directly to, you know, what your SPACs are pursuing, but generally, how are you viewing the SPAC market these days and the opportunities that might be available?
Look, as you pointed out, we raised some money in a SPAC. Important. I can't talk too much about our specific situation, but I will say that, you know, the incentives that relate to the SPAC run directly to our investors, and I think that alignment is important. Look, we think that there's a lot of optionality in having this money and marrying that with a full Elliott platform to find interesting investments. Whether we'll be able to do that over the 2-year period is an open question, but we think that there will be things to look at, and hopefully the environment changes a bit to provide a little bit of dislocation to find things that are compelling.
Right. So I'm kind of curious how Elliott, the mechanisms of Elliott actually work. So you've been co-CEO since, I think, 2015. You work alongside Paul Singer. You keep a much lower profile than he does. And I'm just kind of curious, how does Elliott operate with two CEOs? Like, how do you make a decision on your investments or your strategies?
I think most people know that Paul's deeply involved in every aspect of the business. You know, it's only been 6 years that I've been co-CEO, but we've kind of been together in some form for 32 years, a bit like a marriage. You know, you can kind of complete the other person's sentences, but at the same time, you know, you're able to constructively disagree. And so, you know, we view ourselves as the ultimate risk managers at the firm. So what we're trying to ensure is that the right kind of risk is onboarded at the firm, and that we're there at the moments that key decisions need to be made. And I think we've been effective in doing that. You know, we're also lucky to have a deep team. We have 6 partners, and I have a number of employees that have been with us for 10 to 20 years. We've recently augmented the ranks. We hired Zion Shohead from Citi, who's our COO. Rich Zabel, who's now our chief legal officer, joined us about 5 years ago, and so we managed to deepen the team. So we're pretty fortunate to have that kind of experience to draw on in big size.
So who overrules who when you have a dispute?
Well, I think, we have this natural give and take. I think he knows when I feel strongly about something, and, he's able to run with my decision, and I'm the same way with him. In this kind of partnership, it's really, really important to, never say, I told you so. We're been doing this a long time, and we know that risks don't always turn out the way that we'd contemplated from the onset. And so it's just kind of a natural, I yield, he yields, but both of us are focused on getting to the right place, which is what we try to do in all instances.
So we mentioned at the outset that you're in the office today. How is Elliott looking at bringing people back? You were one of the most cautious people in the beginning. You moved remotely very quickly as the pandemic started. What are you thinking about now, bringing people back, and when do you think they'll be back in the offices?
Yeah, Scott, we were very fortunate to have the infrastructure in place to almost seamlessly move to a remote setting, and it's worked actually better than I had anticipated. Having said that, it's been 2 years now, and I think that there's a desire for people to maintain flexibility. I think people enjoy the flexibility of remote work, but also to convene with regularity. So we're planning on going back to the office in January. I think, barring unforeseen circumstances, we'll stick with that. Look, I think the COVID in some form is going to be around for a long time, and we just got to work through it. But there are important reasons for us to get back, and we will be getting back.
Are you thinking about a hybrid model or a flex model, or do you want people back in the office on a full-time basis?
Yeah, it's a hybrid model. We'll be working 3 days a week from the office. I think people, as I said, enjoy that flexibility, but also miss, the back and forth of convening in person. And so, we're going to do a little bit of both. Look, these things are always hard to know how they're going to play out. So it's a giant experiment, and I'm sure things will go, not according to plan, and we'll have to alter it. But that's the way we're going to start, and we'll just get into it and see what works and what doesn't.
Plus, I guess you have now the added integration issue of having your new Florida offices too. Have you had an opportunity to see whether that dynamic's working yet, because you haven't been back in the office, or?
No, we're still remote, and so we haven't really tested the full hybrid model. I mean, it will be a test, and it will, launch in January, and we'll see how it goes. I don't really anticipate that much in the way of, problems. We've been connected remotely for so long that I don't think, working in, other locations is going to be problematic. Plus, we'll be convening regularly together, having more kind of on-sites with the teams. And so I think, there'll be a combination of ways that we, satisfy having, working from disparate locations.